So you kind of ran the startup into the proverbial wall that all the VCs talk about now, like not to do.
Yeah.
But you're in 2007, you're like, I got this.
Yeah, I got this. I
just
thought,
kept the burn high, and
I could make it work because all my metrics were just amazing. 20 to 30% month on month growth. I was already a top 20,000 website on the planet. We were growing, year over year, 200 or 300%. So I figured, yeah, I can make this happen. But no, I couldn't make it happen. And
wow.
so the number one rule
What was it? Do you recall what the burn was back then? Like how much were you burning? Like how much runway did you have?
I don't remember, but I did not. I wouldn't make the tough call to cut my staff. My team was my family, and I failed as a CEO to do the number one job of a CEO is never run out of money.
Hey everyone, welcome back to the Ignite podcast. Today we're delighted to have Fred Campbell. We've been collaborating for years, and I've been wanting to have you on the pod. So thanks for coming on. He's the managing partner of Track, which is kind of a tech-enabled VC firm, which we'll dive into. His impressive career spans decades, lots of different roles at great companies that impacted lots of different industries, applying machine learning to the investment process, which I'm fascinated as an AI person to dive into. Welcome to the program.
Thank you. Appreciate that very much, Brian. Look forward to our exchange here.
Yeah, and we've co-invested quite a few times, so it's great to have you on the program. And it was serendipitous to run into at a conference recently, but would love to get an intro from you for the audience.
Sure. So I consider myself a founder. I don't consider myself an investor. So I think like a founder. I have founded 8 companies. I've had 5 of those were VC backed, including my current one, Track. I have been mostly all of technology since I graduated from Stanford Business School in '93 and started one of the early .coms, and been doing most software companies since 1993.
So yeah, that's an amazing background. Tell us about some of your first 8 companies. Is quite the journey. That is, pretty impressive. Tell us about some highlights from that journey.
Well, I'll tell you what, I'm afraid to say I'm addicted to the whole startup land. Since the '90s, I've done the first one was the eGreetings, which did great. It was a top 20 website on the planet. It went public in 1999. I had a couple of other exits for decent profit, but I had my share of losses. I had a company that was growing. Was one of the first, if not the first, audio blogging sites, a mobile app called Lexi, that I was raising a Series C ABC for in 2007, when the market just fell out. And I thought I was a pretty good fundraiser, so I figured out, this downturn's not going to bother me. But I just ran out of money. I could not raise money to save my life. And a great company.
So you kind of ran the startup into the proverbial wall that all the VCs talk about now, like not to do.
Yeah.
But you're in 2007, you're like, I got this.
Yeah, I got this. I thought
kept the burn high, and
I could make it work because all my metrics were just amazing. 20 to 30% month on month growth. I was already a top 20,000 website on the planet. We were growing, year over year, 200 or 300%. So I figured, yeah, I can make this happen. But no, I couldn't make it happen. And so the number one rule.
What was it? Do you recall what the burn was back then? Like how much were you burning? Like how much runway did you have?
I don't remember, but I did not. I wouldn't make the tough call to cut my staff. My team was my family, and I failed as a CEO to do the number one job of a CEO is never run out of money. So I've done that, unfortunately, and it was a painful lesson. I've also had a company, mobile broadcast.
In hindsight, at what point in the runway would you have started cutting?
God, if I could do it all over again, I would, with a year's capital, I would have started my cutting my burn.
A year.
Yeah.
Wow.
Yeah. In a difficult environment, and again, this from doing a number of companies and now investing a number more, you need to start fundraising in a tough market about a year before you need the money. Because once you get anywhere close to anything after 6 months burn left, you're going to get hammered by investors. They're just going to see. Unfortunately, that's when the sharks come out. So it's if you can raise money, it's going to be at some ridiculously low valuation. So unfortunately, most CEOs do not start raising money early enough, and they don't raise enough because if you only raise a year worth of capital, basically you got to start fundraising, the day after you close. Yeah, it was a painful lesson.
Yeah, that's tough. What about some other highlights? Maybe not ones where you ran out of money.
Well, so I've had two companies that have failed, and those two, Lexi and Mobile Broadcast Network. Yeah, it's more fun to talk about the winners like eGreetings. When public, it made a lot of people a lot of money. But the failures, I would not be doing what I'm doing right now if it wasn't for Mobile Broadcast Network. That company was. You remember Vine? It was a Twitter
Yeah.
video.
Oh yeah. Very popular.
So
Yeah.
I was before Vine with a collaborative mobile video platform. Mine was for media professionals, and it was just too early. And it was a brilliant piece of technology. And I had lots of clients. I had Time Warner, I had McClatchy, I had some of the biggest media companies in the world that were my customers willing to pay me. But the people on the street, it was just too early. And the idea of holding a mobile phone up to do a podcast or video cast was like, I can't do that.
It's just exactly what we're doing right now.
Yeah, exactly what we're doing right now, right? So it was just too early. So I left that thinking, okay, I'm not going to make another boneheaded decision like that. I spent a couple of years of my life and a couple $1 million. I'm going to find technology that will help me as a founder better understand market timing, product market fit, market size, competitive landscape. And there just isn't anything out there like that. There wasn't at that time. And so that what got me to build my next company, CrowdSmart.ai, which has essentially become Track. Yeah, so I love what I'm doing right now, but I wouldn't have been doing it if I hadn't failed at Mobile Broadcast Network.
I love that. Yeah, so let's talk about the inception of what became Track and what was that and where'd that idea come from?
The inception of Track was a company called CrowdSmart.ai. It's still going right now. My business partner and co-founder was a guy named Dr. Tom Keller. And Tom was a brilliant dude. He was the chief scientist and the CEO of the first AI company to go public in the United States called IntelliCorp back in the late 80s. And it was kind of the first wave of AI. And he then started another company that was bought by Satmetrics, another AI company, back in the mid 90s. And he and I got together in 2013 to see if we could solve the problems I just described: product market fit, market timing, that sort of thing. And we did. By 2017, we had a small fund that we launched that we were using our technology to make predictions of pre-seed companies. So this would be first check in. And Brian, if you're the first check in, your odds of one of those companies making it to a Series A, and that's how we define success, by the way, for CrowdSmart, was can this pre-seed company not just raise $1 million seed, but can it raise 10 million A, right? And CrowdSmart to this day is about 80% accurate at identifying pre-seed companies that can make it to a Series A. Our little fund, we made about 30 investments. Something like 70% of those have raised Series A. We have a unicorn in that group. That fund is doing really well.
Oh, wow.
But that
what year was that fund started? This is pre-Track?
Yeah, this is pre-Track. It was called the Titan Fund, and a little $3 million fund. I mean, it was just a proof of concept fund. The Titan Fund, again, started investing
like 50K check, 50K, 75K check kind of stuff.
Yeah. It was very small, and we liked being the first one in. So, for example,
and that's super risky being the first one in with a small check.
Yeah, it is. But there's a company called the star of that fund was a company called Sentient, which is an AI company that is we invested at $10 million valuation, and I don't know the last valuation, but it's a big number. So that's we're going to return the whole fund plus 2 or 3x just that one investment. But there's out of that 30, there's probably 7 companies, so a little over 20%, that'll probably all return sort of 5x to 10x or better.
Nice.
So it's doing quite well. But Tom didn't like being a VC. He didn't want to use the technology to make investments in startups. He wanted to provide this technology to big corporations, to governments, to all
Yeah.
sorts of stuff.
Sounds like I need to plug in the Team Ignite deal flow to this
Yeah,
this app.
yeah, you would have a perfect environment for that, by the way, because that's what
Yeah.
you needed. It relied upon a community of people. The AI would pick the team of evaluators, and then the AI played the role of the moderator, and the evaluators had a kind of a 360 view of the company.
Oh, wow.
Would interact with the company to make the prediction. It was incredibly accurate, but also very cumbersome. So you need a big community to make that model work.
Yeah.
But if you have the
like a team Ignite.
yeah, like a Team
I'm just joking.
Ignite. Yeah, no, it'd be brilliant for you. But
Yeah, I think that'd be smart. I knew there was a reason I did this podcast.
well, I'd be happy to introduce you to Tom. He's a great guy. And so Tom and I decided he was going to run that as a predictions as a service business for people who can afford $25,000-$50,000 of prediction.
Oh, wow.
Yeah, so it's expensive.
It's really expensive for pre-seed, though. Yeah.
Yeah, way too much.
Yeah.
And then I took the chief architect, a guy named Scott Pine, and merged with another group that we had sort of co-founded to form Track with similar technology. It's based upon science of collective intelligence. So Track has the capability of tracking, hence the name, pretty much every company on the planet. If you have any kind of pulse, if you've raised any money, if you've got any web traffic, if you've any media mentions, you've got a social media presence, we know about you.
Interesting. So you're scraping the web for any digital signatures of companies, right? You got the class one probes, use a Star Trek reference, out there scouring the internet, the universe of potential startups.
Fortunately, you don't have to scrape much anymore because there's we live now in an environment where literally almost every week I get a new company,
new API,
who's selling something. We just hired another data scientist, started last week, and we were going over, who first thing he's going to do is he's going to go interview about another 6 or 7 new sources that have arrived since pretty much the start of the year, or recently. So we'll see which ones of those we want to incorporate on our database. So it's a great time to be in the data-driven VC world.
Yeah, definitely seems to be a sea change. Do you think, kind of putting my VC hat on here for a sec, do you think the VC industry will always have space for kind of the more art versus the more sciencey ML driven part of it?
Yeah.
Or do you think it all goes machine learning based? Because I've had quite a few VCs that use data and machine learning to understand and inform their investment decisions. Or do you think there's always like this space for like the gut human kind of feel for that founder and market?
There's a guy, it's called Philip Tetlock. He wrote the book called Super Forecasting: The Art and Science of Prediction, and he ran a website called the Good Judgment Competition, and it was a fun little thing. You could sign up, and he asked for, what do you think this is going to happen, by this date, and you would make your prediction, and he'd keep track of it. And that's effectively what VCs or investors do, right? You make your best guess, basically. And what he found was that a very small percentage of people who are predictors are actually predictive. And the best of those he calls super forecasters, hence the name of his book, Super Forecasting: The Art and Science of Prediction. And what he found is that to get the best predictive technology in the world is actually a combination of human and machine intelligence. And he proved that by winning, you probably heard of DARPA. Well, there's something called IARPA, which most people don't know about, but it's the Advanced Research Group for the Intelligence Community, the CIA, FBI, NSA, that kind of thing. And they run a competition, or they did, on who has the best predictive technology on the planet. And Tetlock won that with a combination of human and machine intelligence. And that's hence the book, Super Forecasting. And I was privileged to get the chance to interact with Philip and then work with his 2 leading peers, guy named Scott Page, who runs the Cognitive Science Department at University of Michigan. He wrote the book Diversity, which is the science behind collective intelligence, and Dr. Malone, who runs the Center for Collective Intelligence at MIT. Collectively, they came in first, second, and third place in this competition that had, the big data companies, that had Rand Corporation. So collective intelligence was proven to be the most predictive technology on the planet. To get to your point, it's a combination of people and machines. So
Right.
people are important.
Yeah, and I think that point fleshes out with other domains where AI and machine learning have, previously beat humans like in chess. But now the best are kind of these minotaurs, these AI enabled human teams that are performing the best, which is pretty promising.
Yeah, I mean, the whole idea of a co-pilot makes a ton of sense. I mean, if you're going to do a real competitive analysis that we do at Track, there's no way you can do it by yourself. I mean,
Mm.
there's just too much data to do a true competitive analysis. And, that's what AI does really, really well.
Yeah.
So yeah.
So what are some of those signals that the data or the model have the highest predictive power? Like, is it the typical stuff that VCs look at, like team pedigree and traction and timing and stuff like that, or what are the signals that feed into the track model that are maybe would be surprising for the audience?
Sure. I think there's probably a lot of different models. Have you interviewed or had a chance to meet Jerry Yee? He's the chief data scientist. He was at Signalfire, and then just recently, last 5 years at Lightspeed. Jerry is a friend of mine, and we've been comparing notes since my 2013 timeframe. And so Jerry has been looking at team composition, and he would tell you, if you were here, that there are some signals, especially in the collective, in the not just one person, but the group score for a team.
What's the group dynamic?
Yeah,
You got to have the technical person. I really like teams, for instance, that have really strong technical kind of founder fit, and then a real strong business founder fit. And then, of course, I especially in SaaS now, I find that having somebody that's really good at design is a competitive advantage as well.
yeah, no, absolutely. So the team composition is important. Track, our thesis going into this was that what we learned from CrowdSmart was that we had a community of about 3,000 investors that our AI could pick who was going to be the 20 or so people that were on the evaluation team. And what I learned is that if you can get independent, knowledgeable people around the table who had a diversity of views, that those people initially acting independently and then collectively coming together in different ways, that turned out to be a really strong signal, that collective intelligence
Hmm.
of an investor, of a knowledgeable investor group. One of the
Yeah.
things that Track has done is that we have scored basically the predictive ability of about 300,000 venture investors. And that turns out to be really hard to do because the current classification systems on like PitchBook and Crunchbase and Track, they're all just terrible. So that we had to
What do you mean
invest.
by that? The classification systems of when they invested, what stage, things like that,
No,
or
more fundamentally is if you want to evaluate the quality of an investor, it's within like for example, you want to look into space technology. Well, there's people that know a lot about launch vehicles. There's people who know a lot about satellites. There are people who know a lot about whatever, right? The machinery that goes into building whatever. So if you want to look at a company or the quality of investors, you need to be able to very accurately identify the segments are that you're looking at and evaluating the performance of those sectors. So that's probably the hardest thing that we've done over the last decade was be able to very accurately assemble a group of competitive and similar companies for
mm,
evaluation. And then that tells us a lot of stuff. It tells us the quality of who are the best investors within that group over a period of time, and that allows us to grade the quality of any investor group of any company we look at, because we know how to look at that investor quality within that group of investors. I'll give you
But
an
you guys are often at Track going first check in, it sounds like, in the pre-seed. So there are no investors, right?
That was CrowdSmart.
Okay.
Track, we didn't think we could invest at the seed stage or the first check stage because the data just didn't exist.
Right.
For us,
It's just
right?
too nascent, too early, right?
Subsequent to that, a number of entities have, I can't share who they are, but investors and accelerators and university environments have started providing us with their data on their portfolio or their companies going through their programs or whatever.
Yeah.
And then we give them back the scores in exchange for the data. So we're now able to invest at a very early stage, at the first check stage. But it's a unique situation for us. So we generally,
every time I send you guys deal flow, you send me back the score, actually, which is really nice of you.
Right.
You're like, hey, we evaluated it. Here's what we think about it, and here's why. Which is value add for me.
Well, I'm glad that that's the case, and it's a great quid pro quo, because then we get to see which companies we might want to invest in, and we do that with a number of VC firms, early stage VC firms, and it's worked out well for us. Yeah,
that's amazing. What are some other kind of surprises or mundane from your learnings at Track?
Yeah, if I had to say the one thing that I was surprised at, there are some things that are scientific valid. You can test them and you can, your thesis, but there's other ones where you just see a really high correlation and you're not sure if it's causal or what. Probably for one of the things we've done is we buy from Meltwater and Aller, and which the same companies, a lot of different sources, media from all sorts of different sources. And if you look at the ranking, the performance of any competitive set, it's almost directly correlated with who's generating the most media footprint. So when you can measure the footprint of an entire competitive set, it's almost one for one with how the company is likely to do in the near future.
Interesting.
So
it's almost like the intelligence of the entire media community, the
that's exactly what it is.
All the tech crunches of the world and Verges and all of these are, if they're covering this company, it's probably pretty interesting and exciting and has high predictive power of like, hey, this is going to go places. So getting that media score as an input sounds like it's highly correlated to outcomes.
It is highly correlated. What I don't know is are those, we try to grade the predictive quality of media for each author, right? It's a little bit challenging, but that's part of what our algorithms do. Are they influencing the outcome?
Yeah.
Or are they just reporting on something that's already happening? I'm not sure which one of those is true. But I can tell you that they're almost one for one correlated with
that's funny
how the company is going to be doing over the next year.
This is part of the reason we started the podcast in the first place. It was when I crossed about 100 portfolio companies. I said to myself, well, one way to help them is to have a place for them to get their message heard.
Yeah, absolutely.
And we have tens of thousands of followers on social media. So hopefully we help in just some small way to get them more media coverage. So that's interesting to hear that media coverage is a predictor. So that validates our reason for existing with this podcast.
You're doing your portfolio companies a major service by getting them out there and helping them.
Oh, they love it. Yeah.
A lot of founders, unfortunately, do not prioritize. I was asked to speak recently at an event, which was basically, does a founder pitch differently to AI than they would human? And the answer is yes, absolutely. You want to think about who you're pitching to, and they're different entities. And even if it's even if it's a VC who ultimately makes the decision, if they're being informed by their data, then you want to address the data. And
Yeah.
one of them is, pay more attention to, like, don't do a stealth mode company. That doesn't help you in the AI world, right?
Mm.
If you have data, and it's not reported accurately on Crunchbase, CB Insights, PitchBook, make sure it is. Just clean the data.
Yeah.
If you post, and a lot of people on LinkedIn, for example, and you get people to repost you, that actually makes a difference to the
Yeah.
to the AI.
Yeah.
So
100%.
just pay attention to, I mean, your website, how you describe yourself in your website. And if you can show a trajectory, because the AI knows everything that's ever been written about you or your company. And so if you can see a trajectory, like our algorithms are designed to look for momentum. So if you can see momentum, then that's a really positive thing. So don't hide
Yeah.
it, put it out there in the world.
Right. I love that. So tell us about how your investment thesis or philosophy or what sector, stages, geographies you play in have changed, and how many funds you have, how big are they, how many investments, all that stuff.
Sure. So we have, I'll go backwards. We have two funds. The first one was 31 million. The second one was 42 million. We consider these almost proof of concept funds. They're the technology is actually stage agnostic and sector agnostic. We have chosen to go as early as we can just because it helps with the return multiple.
Yeah.
And we've chosen not to invest in certain categories where the science is not as predictive. First, so for example, drug discovery. It
Yeah.
used to
I
be
mean,
drug discovery just takes forever. And anything beyond about 7 years, according to Dr. Page that I mentioned earlier, collective intelligence really is not very predictive if the outcome, the product market fit, is not known for 8 or for longer years. So anybody's guess is as good as anybody else's.
yeah.
So we're, other than drug discovery, we also don't invest in, our LPs don't like that we invest or don't want us to invest in typical sin stuff,
Right.
firearms, tobacco, drugs, alcohol, whatever, right? That kind of stuff.
Yep. Yep.
So other than that, we're wide open.
So you did 30 in the first fund. What are the stage ranges in the first fund versus the second fund?
So we've done a total of 85 investments to date, 46 in fund one, rest in fund two. We mostly are one and done, although we do have 10% set aside for follow on. So we just did our 100th investment last week, and the fund is doing very well. Fund one, according to Preqin, which follows, funds by you probably have talked about this in your show, but Preqin has data on funds by vintage year, the year you first invested, and by early stage, late stage, growth stage, or growth stage and late stage. Our first fund, 2020, for track is there's 740 something early stage 2020 funds, and according to Preqin, we're the 11th out of that group.
Wow.
And for the 2022 fund, there was 840. We're number two out of the 840. So we're
Wow.
pretty happy with the results. Now that's mostly based upon what's the follow-on percentage of of your portfolio that had one or more follow-on,
Yep.
which we have a really high rate on, and then how many of those have been out of business. So, for example, of our first 85 investments over the last 4 years now, we have 4 companies that have gone out of business or sold for less than
Yeah.
our investment. So, which is,
I'm about the same. I'm about 4 out of 127.
you're
I'm doing
better.
pretty good so far.
Yeah, you're better than we are. That's great.
We'll see
So,
over the long term. I'd
yeah,
love to go see what my investment performance matches up on Preqin. I should go look that up.
yeah.
You have to submit to them, or they somehow figure it out?
No,
Like they somehow grab.
you have to buy a subscription, and then
Yeah.
you if they don't have all your data, you load up your data into their platform,
Okay.
and they
They go by the fund made the first investment. That's the vintage, right?
Yeah, that's the
Got
vintage
it.
year. Yeah.
Okay. Yeah.
So that's great. Well, congratulations on that success as well.
Well, not only that, and I've said this on this podcast before, but they're all consumer low margin businesses. So I've kind of learned my lesson there. So my little anti-correlation matrix in my head is like, ooh, solo founder, consumer, low margin, difficult to operate businesses, right?
That's great.
And these are the kinds of things you see. But I'd love to, and I actually have a machine learning data scientist intern this summer, really bright kid that's gonna help me start integrating some AI into this stuff, because we've been looking at 500-600 companies a month and have a database for all the times we said no and all the times we said yes and
That's
what we
brilliant.
said and
Yeah.
why, and maybe start back testing some of that and then kind of informing. The dream for me is exactly what you said, which is this hybrid approach where the AI could get us 90-95% of the way there, and it's still a human judgment at the end of the day. Like, how does your investment process work? Is it purely like just the AI says that we should invest and we invest and we don't even review it? Or is it, hey, it just informs, here's the short list of the best stuff? Or walk us through that process for you guys.
So it's really kind of what you described. The AI identifies the group of companies that meet the criteria, and then we then apply rules and sort of common sense. But there are
Some common sense, like, hey, we don't do this drug discovery stuff. We don't do this stuff.
Right.
There's some just off. Yeah. Some hard and fast rules.
So, for example, a rule for us is we won't invest in a company that doesn't have at least 18 months of runway when we invest. So that's a rule.
Same.
Right?
Yeah, that's a good rule. Yeah.
And so the AI.
Is there a revenue minimum that you'd like to look at, or will you go pre-rev?
We'll go pre-revenue. Yeah.
Wow.
Yeah.
Wow. I don't typically go pre-rev unless it's like a second-time founder and I just have high conviction that they can execute.
Right.
I think cash talks, right? Bullshit walks is the old phrase. My dad would probably
that's going to
say it over and over again as a kid.
Well, yeah, and Brian, that's going to exclude a lot of companies you might want to invest in. Like, for example, the whole space technology. I mean, they're not going to have any revenues for any length of time, right?
Right.
But one of your pre-questions, and I don't want to give anything away, was who's your favorite CEO? And mine right now is a guy named Andy Lasky, who's the CEO of Stoke Space Technology. He's a rock star of a CEO. He's like the poster child. You want every one of your CEOs to be that much on top.
Those are my favorite founders to me. Like, that's the best part of this job that people don't realize is, as a VC, we can be cantankerous and kind of a gnarly bunch, but we love meeting amazing founders, right? That's what keeps us going is that call. Like, and there's only a handful a week, honestly, out of everyone we meet. Unfortunately, any founders out there, sorry, but only a handful a week where you just like, you get off the call and you're like, just send me the wire information. Like, I'm on board, because you just could tell the star quality is so high. And I'm curious, like, how much does that feed into how you guys make investment decisions? Is it like the AI says it's number one? We also think it's number one. It's an easy yes. Is it that kind of equation for you guys?
We just had a call this morning to talk about a company that met our criteria, but the industry that it was in has the industry has had a total of about $1 billion invested in this competitive set by VCs, and the top valuation as of today is $112 million. And the return multiple, the total money in versus the valuation averages about 2.5x. We said, there's just no indication that this is a marketplace that's going to support a bunch of unicorns. And so we passed, even though that AI said invest in that company.
Yeah.
We did make the rules.
That's the human judgment, right? Because sometimes you look at something and you're just like, this doesn't make sense. I can't squint at this enough to have it make sense, because a lot of what we do as early stage investors is kind of looking for stuff that's non-obvious to everyone else. Because it was if it was obvious to everyone, it would be 100 cap or a $50 million valuation. And you see a lot of this out of YC companies, which I love YC. have a YC fund. We invest in tons of YC companies. Love the program. But sometimes the obvious stuff that's coming out of that program gets bid up so high. And I saw this back in, 2020, pre-rev, 3 Google engineers, YC, crypto, Web3, blah, 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 50 cap. And I'm like, come on, guys. Like most startups don't even sell for 10 million.
Right.
And you guys are raising a 50 cap pre-launch, pre-rev.
Yeah.
So that's the human judgment that has to come in. It's just like,
right.
Versus my best companies, I'd hate to say it, but my best companies are just growing super fast when I invest. I look back at all this, like it's like literally like, it's the first thing I look at in my deal flow submission form is like, what's your traction?
Right.
How's this going? Because cash talks again, right?
Right.
If like revenue kind of solves everything else, I forget who said that. I'm paraphrasing, but
right.
if you see a company that's just doubling revenue month after month for 6 months, it's like, okay, like
right.
you would clearly have something here. And like, let's look at all the other stuff as well. And is it a crowded space? And are you raising at 100 cap with 500K of ARR? Probably not for us. Probably
right.
too expensive. But
and that's, I admit, so it would be ideal to have that. So I think we just put in our quarterly report out. I'm trying to remember, but less than 70% of our companies have any revenue, or 70% have revenue, 30% have no revenue. But of the 70% that have revenue, half are really nascent revenue. They haven't.
Yeah, you're talking like 3,000 of MRR, 2,000 MRR, like almost nothing. Yeah,
almost nothing, right? So we are playing a slightly different game than what you're doing, Brian. But we love it when we see revenue growth going through the roof. That's
right.
a nice thing, right?
And I'd be a liar if I said I only look for revenue, because I've invested in plenty of companies that are very nascent and very early. But
right.
you have to kind of you take a double or triple look at those, because everything else has to. We have 15 different things we look at, and we score them on a 5-point scale, and we kind of hopefully we'll backtest that someday with AI. But all the other things have to be amazing if it's very early.
I applaud what you're doing, because if you apply it consistently. I was talking to another managing partner. I think it was Pathfinder, and I could be wrong on that. So that could be not the right name. But they've probably put in 200 companies per fund, early stage, the seed stage, right? They want to be the first check. And
a similar strategy to us,
yeah. And he's said their first fund was returned more than 6x to their LPs, and they've got, I think they're on 4th or 5th fund now. And he said, we don't know what's going to work. I have no idea. But
I quipped on Twitter recently. It was like, or X, whatever you want to call it. Half of my startups are going to zero. I just don't know which half.
Yeah, exactly.
Which is kind of like to borrow the marketing aphorism of, half my marketing budget's wasted. I just don't know which half.
I asked him. I said, "What's your secret? What do you that you can share?" And he said, "I've got my list of rules, which we've evolved over time, but it's my rules, and it's just you meet the rules or you don't, and it's just I can make a quick decision, and it's working for us."
And there's no right way to do venture, but there's plenty of wrong ways, right? And everybody has their own niche and their own way of generating alpha. But the high volume strategy, I've talked to lots of spray and pray approach investors, and we are one of them. To use a disparaging kind of terminology for the way I invest, but I mean, there's 10,000 companies that get early stage financing every year,
right?
And 200 or 300 of those are turning into unicorns. So how do you find the 200 or 300?
Right.
Well, you could use have really high conviction and think you're really good at this, and then if you do that strategy, though, you're either really right or you're really wrong, right?
And most are really wrong.
And most of them are really, really wrong, right? They do 20 or 30 investments and they're really wrong. You guys have been fortunate because you're using a data-driven approach, which helps you be really right with a smaller number. But I think more artistic inclined VCs like us, we're doing 150, 200 per vehicle. We could be wrong a lot with the high volume. But we only have to be right like once or twice.
Well, but
right?
What is amazing about yours, Brian, is if you made 120 something investment, you said, and only 4 have gone out of business. That's a really very, very strong number, right?
Well, I cherry pick, right? So I wait until they have 20 or 30K of monthly recurring revenue. And then it's kind of a no-brainer at that point, because AI, and another part of our thesis is like AI is generating so much leverage now in software.
Right,
It's eating software, where I'm running into founders that haven't hired anybody and they have 1 million of revenue.
right,
So they're default alive
right,
already,
right.
versus these kind of low margin consumer, one founder leaves and then where there's only ever one founder. Those are just really risky businesses, and I've learned to just like, that's a hard and fast rule for me now. It has to be a really special company with really special growth for me to go solo consumer at all at this point.
Mhm. And who? I'm sorry, I should have asked this question, and you can just cut this bit out. Who's the primary audience for your podcast?
Yeah, so I think we skew male, 35 to 55.
I mean, are they founders,
Yeah,
they investors?
I think a little bit of everyone.
Uh-huh.
Yeah, it's definitely founders, definitely fellow VCs, angels. I mean, Team Ignite itself has thousands of people on it now.
Uh-huh.
So we're getting some pretty good coverage now.
That's great.
Like for me, I would do this even if I had, like I said, 100 million in the bank. I just kind of would keep doing this podcast, and I keep investing in startups. I don't think I'll do anything else. I think I'd have a staff and I'd have better data science like you have, but I wouldn't do anything
It's a
else.
lot of
And
fun,
so
isn't it? I mean,
it's so much fun.
I have my perfect job. I really do. After, at this for a few years, a couple of 3 or 4 decades now, I get to build really cool technology. I love dealing with my engineers, my data scientists, and then I get to hang out with guys like you and founders and who are changing the
Exactly.
world. I mean, it's
Yeah.
just a lot of fun, right?
Yeah. Yeah, I can't imagine doing anything else. I mean, I don't know if I could go back and build a single product. I built product for a long time and it was a lot of fun. And if I had to go back and have a job, I think I'd be a product manager somewhere at some really amazing AI powered bloody block company. But we could do that in venture, right? We
Yeah,
can use AI and data science to accelerate what we do here. And
yeah.
I think in the future, AI is going to get so powerful that all we're going to have is just like podcasts and art and music and stuff to share, because AI will do a lot of the heavy lifting for us.
Well, in a different way of looking at that is that, and you're an example of that, is you are a media company with a VC business model, right? So
Yep.
we're a software or predictive software company with a VC business model. Yeah, I suspect. I mean, I got a call about 4 years ago from a guy named Larry Fink, who I didn't know from Adam, and when the nice lady said, Mr. Fink would like to meet you, and I said, that's nice. Who is he? And he said, well, he's the founder and chairman and CEO of BlackRock. And I said, that's nice. I've heard of that company. What do they do? And true story. Anyway,
Oh, wow.
I was on the next flight out to meet him, and he said, what I'm looking for, and he was following CrowdSmart at the time. He said, what I'm looking for is a way to disintermediate VC. He said,
Wow.
what he thought, this is what he told me, is that the early stage, to your point about humans, or what's the role of humans, the mentor investors are the highest value add in the VC business or the venture business, right? They're using their experience, and by the way, what we call
Yeah, these are like kind of the benchmarks of the world, where they go really deep. They take the board seat, they write a huge check, and they're
yeah,
in it with you every step of the way.
and maybe even earlier when you were writing personal checks,
Mm.
and then providing your product and other experiences. So when we grade of investors at 300,000, there's about 300 that we call super forecasters that have earned that title, and 80% of those are individuals, not VC firms.
Wow.
And of the 80 of those 300, 80% of those, whether or not they were individuals or now are VC firms, they were first founders of companies, and they've had both success and failure, but they were founders with 10 years of founder experience
Wow.
before they went into investment. Kind of very similar to what you're talking about for yourself, Brian, and me.
Wow, I've only ever failed. That's what makes me a great investor.
Well, that's true. You know how hard
Yeah.
it is when you
Yeah,
talk to a
it's
founder.
terribly hard.
Founders know that you appreciate how difficult it is to be in their shoes, right?
Yeah.
I mean, I believe me, I've had a lot of the dark night of the soul, thinking, "What am I doing? My company's out of business, and
Yeah.
whatever." It's hard, and when you're changing the world, you're building something from nothing. It's hey, my hat's off to you. I'll do everything I can to help you.
Yeah, I know. I've been there. Like, I've had to, lay off a bunch of people and, failed to raise money, and it's tough. It's
It's tough.
tough. And you're
It's
just
tough.
like, just back against the wall and a very dark and lonely place. And I try to tell my founders, like your story about running it off the cliff, so to speak, in 2007. I was watching some founders do that this year. I'm like, what are you doing?
Right.
You have 3 months of runway.
Yeah.
You need to figure out how to extend that to 12 months right away.
Right now.
Like
Right now.
right now.
Right now. Yeah. Yeah. I did the same thing. I said, guys, your number one job is you never, ever, ever run out of money. Because what you think you're saving somebody, I did the same thing. Believe me. All right. I think
Yeah.
I could do it. I could save my team. No, they all lost their job because of me. Right.
Yeah.
And so yeah, and that's not that's the worst of all outcomes. So yeah, this environment is really tough, as you know, Brian. This is a tough
Yeah.
environment for founders.
But also like a really great time to be an investor.
It is.
Because
Yeah.
if you find the companies that are growing right now and with all these high interest rates and macroeconomic headwinds and wars in multiple places in the world and all that stuff, if you can grow this, in spite of all that stuff,
Well, to your point,
you're probably a pretty great company.
we've analyzed, if you consider every year portfolio, do you know the two best years before, we'll see how this year is due much later. From 1999 to 2000, our last data would be for the full year of 2023, but it's too early for there. What's the best 2 years in that entire 20-something year span? Just take
2002 and 2009, most likely.
So 2008 and 9 were the two best years back to back.
Oh, wow.
Right?
Yep.
And
Wow.
if you had invested alongside these super forecasters that we talked about, your return multiple for those 2 years would have been above 200x.
Wow.
Yeah,
Insane.
right. It just so yeah.
That's where some of the most famous seed funds of all time were founded too.
Yeah.
Like I think it was like Chris Dixon's seed fund went 200x or something in those
crazy,
years.
Right. So to your point, this is a great time for investors to get in, and why people are sitting on the sidelines right now is crazy. But there's a lot of fear out there among VCs. There's some good companies that are struggling to raise money.
Well, yeah, and I think they got ahead of their skis in 2021, 21, 22, kind of, going out there and deploying all the capital within a year and then very sky high valuations, 200x kind of forward ARR stuff. Whereas the smart VCs, I think Benchmark especially, I just heard one of their partners on the 20 VC podcast, which, by the way, that's all I'm doing is I'm just following, in the footsteps of Jason Calacanis and Harry Simmons and doing a podcast, right? It's not my idea. It's their idea. And they do an excellent job. So shout out to those guys for producing great podcasts. But, they had a partner on Benchmark and they kind of sat on the sidelines a little bit. And all their LPs are like, what are you guys doing? You're kind of missing out, right? Like, well, we think the market's too hot right now. We're just not we're going to be patient. And turns out that paid off, right? Versus, Tiger Global going out and writing 200x, 300x checks. And how much did they have to mark down their portfolios? Like 80% or something?
Yeah.
Just a massive markdown.
Yeah. I mean, it's just, they were, I blame them, quite frankly. And, a couple other funds were just, they have too much money for their own good. And they were just making stupid investments and not helping anybody. I mean, I can't blame founders for taking these crazy valuations, right? But
yeah, what do you think the limit is to your model, like in terms of fund size? I'd be curious, and number of checks. Like how scalable is Track?
Well, I don't know if you just saw it, but the first ever data-driven VC conference just was earlier this week.
You were there, obviously.
We were among those there, yes. They've identified 160, I think it is, I think that's the number. VCs made the data science list, and yes, Track is in that group. So it's a very exciting time. I mean, when
Yeah.
we first started CrowdSmart, there was, I think, Signal Fire, Correlation Ventures, and us. That was pretty much it. So it's definitely moving that direction, and it's a really exciting time, I think, to be an LP now you've got lots of options to look at this space, to look at a different model.
I think it's a supply and demand thing, because I think if you are great at generating returns, you can actually
Charge
press
more,
on the numbers a little bit. And some of the big VC firms have, right? I think some of the big VC firms have escalating carry, right?
right?
Where, hey, up to 3x it's 20%, and 3 to 5 is 25, and above 5x it's 30.
Well,
And I've done that in fund 2 for my YC fund.
right.
YC fund 1 was straight 2 and 20. And I'm going to do an escalating carry arrangement. And I think it sends a signal to LPs like, hey, I'm confident. I'm so confident I'm going to
Yeah,
generate good returns.
yeah.
I want more of the profits, right?
I don't disagree with that. I think if the more profitable, the more. I mean, my business partner used to run a hedge fund that was you're going to pay all my expenses. I'm going to have a benchmark of the Standards and Poor's. Everything above that, we split 50-50. I mean, he made a
Oh,
fortune
wow.
with that model.
Oh, yeah.
But to Larry Fink's point, he thinks that the early stage investors, the individuals and the VCs that are really providing the value add, they will continue to be able to charge whatever they want. But later stage, he wants to work with successful high volume companies like yourself and maybe ours, that then he can reduce the cost of capital for investors and get more people involved in the innovation economy. And so he would argue that the just like the fee structure of Wall Street has come crashing down. I mean,
Yeah.
you can trade on Robinhood for what, nothing basically.
Yeah.
So,
Well, they'll even give you incentives to transfer your 401k there now, right? They're giving that like 3% or
right.
something, 4% if you
So
keep it
the
there for 5 years.
VC has been an access game, and I think that's one of the things that AI will probably do a little bit. Will change the game around a bit.
Yeah.
And
Well, especially when AI equalizes everyone's access to data science and analytics.
right,
When I can chat with GPT 5, 6, or 7, and I can be like, hey, I'd like to use data science and analytics to better inform my investment decisions.
right,
And I don't have to hire somebody or have the resources for that. Then somebody might go, you know what? I don't have to hire anybody, to your point, to run a $100 million fund. Maybe I can do it by myself. Instead of paying myself $2 million a year at 2%, I can easily live on $1 million and maybe have like 1 or 2 assistants. But yeah, I'm just throwing numbers out. I don't know.
yeah.
That's not me, but so yeah, to your point, like maybe AI is this democratizing, drives the supply up, because at the margins it's cheaper to produce everything, including venture capital.
Including venture capital. It's hard for me to put my head in the VC role, even though that's how I make money. I look at it from a founder's. I mean, I used to spend a massive amount of time raising money for my companies, and you get better over time. If you've made some money for people that it's easier to raise your next round. But there really isn't a particular reason. I mean, part of our analysis is of the 300,000 investors that are out there, 1/10 of 1% are the only 1/10 of 1% are possible investors in your company. So there's only 300 potential investors for any company out there in existence, right? So your job as a founder is like needle in a haystack, right? So part of what AI can do is for founders is help them identify the needles, right? So they're not
Yeah.
pitching to a bunch of people. I mean, I used to have if I would pitch to 20 people, and this was along Sand Hill Road, as a Stanford grad, and I had access. If I could close one, I was happy. I mean, 1 out of 20, that was a lot of pitching. And then
That's
of course,
5%. Yeah, it's
yeah,
pretty typical. Yeah.
and for track, because I use my own data, I don't pitch anybody that I don't have a high confidence they would likely invest in my company. So my
Mm.
close rate was about 80%. So, as a founder, that's hugely valuable. That frees up
Yeah.
time so I can build my company and not pitch everybody.
Yeah.
So I think AI is gonna help democratize, help investors help founders actually identify who they should be pitching to, who's
Right.
likely to add the most value to their company. in various ways. So that the access game that VCs have been playing, I think, is going to go away. So the world's going to change for everybody. I think in a positive
Yeah.
way. I believe.
Yeah. Yeah. I'm a techno optimist. I can only see things getting better over time. Do you have time for some quick rapid fire to wrap up?
Sure.
What was your first job?
I was a busboy
Nice. At a restaurant where you grew up or
at,
whatever?
at Newport 17, fine dining establishment in Newport Beach.
Oh. What's your favorite tech gadget you can't live without?
That's an easy one. I couldn't live without my phone.
Right. Extension of our brains now.
Yeah, it is.
What's one startup from history you wish you could have invested in?
God, there's so many, but I'd say of recent time, it would be SpaceX.
Yeah, I love that one. Best piece of advice you ever received?
Pursue your passion, because quite frankly, it takes so much energy to do anything in this world, and building something from nothing, when mostly you're going to get naysayers. You better be passionate about it,
Yeah.
to get through the dark night of the soul and just,
Yeah, you know what? You know what's uncomfortable about that phrase? And I'm someone who lives my passion, but it took me 20 years to find it. It's a real dark and lonely path full of lots of existential angst trying to find your passion. And I pivoted dozens, if not 100 times to try to find mine. But I think it's kind of like being a founder of your own life. You have to keep pivoting until you find that product market fit with passion, right?
No,
You're
yeah,
trying to find, your own PMF.
that's a great way of putting it. My passion growing up was music. I barely graduated from high school. In fact, I had to play at my Spanish teacher's Cinco de Mayo party, so she would give me a D- in Spanish, so I could graduate from high school. I mean, I seriously was a D- student, but I played guitar 7 hours a day. It was my passion.
Oh,
Eventually, I just shifted that passion to something else. It turned out to be, getting decent grades and getting accepted to, the nice schools. And then I put it towards my businesses, and it served me well. I really, I do think, I was lucky. I knew what my passion was, right? But I think that's a great way of putting it, Brian. Just you got to pivot until you find your passion.
yeah. I remember, I think it was Steve Jobs, and this is his commencement address to Stanford, I think, probably around 2006. This is right around the time I was going through my quarter life crisis. I was 26 years old, washing out of Wall Street. And he goes, anytime I looked in the mirror in the morning and I was about to do something I didn't want to do, and that happened too many days in a row, I knew I had to make a change.
Yeah.
This just always resonated with me. And I just always remember that and just how powerful that was. I was like, yeah. And I was like working on Wall Street and I'm like, I hate this. What am I doing?
Yeah, what are you doing? Right.
I hate going to work. I hate riding the 6 train and touching 20 strangers. I hate like everything about this job. I hate like having to sneak out at 8 o'clock at night. Like I just hate this job. And yeah, so it's that was the best piece of advice I ever received. It's just kind of keep trying.
Yeah.
And it sucks, and it's gonna suck for a long time, but just keep trying. What book has influenced you the most?
This is going to tell you a lot about me. Power of Now by Eckhart Tolle. So
Oh, yeah.
I'm a bit of a spiritual kind of dude, though.
I love that. I do transcendental meditation twice a day, which I wish I would have found 20 years ago, but that is the most amazing form of meditation.
Is if I had to put, what one thing you can do to change your life for the better, meditation.
Yeah, because what happened was when I started meditating 20 years ago in my 20s, you start paying attention to how you feel.
Right.
And you're like, I don't feel good. Like, I don't like this, right? And I have a lot of resistance, and you just start paying attention to stuff. And, we're all working through our own problems and demons and past traumas and all that. But
yeah, there's a company we've invested in called Neurable, and it's a brilliant plug for Neurable. But they're coming out with a really nice high end headset that would be like a typical it's like Bose headset kind of thing so you can listen to music, but it also is reading your brainwaves. So it turns out that when you're in a meditative state, you have very different accessing a different part of your brain, and you have a very different brainwave than you do when you're sort of in stress mode, right? And if you're making decisions in a stress mode, you're not tapping into your creativity. You're not tapping into your, your higher intelligence. So when you're making decisions, and most people are stressed out all the time. Right. You're not going to make great decisions for yourself, especially life decisions, right? So
yeah, and different forms of meditation have different waves. Like TM is like I think an alpha wave meditation, and I think mindfulness is like a beta wave. Don't quote me on that, but it's something like and the different waves have different strengths and weaknesses. Anyway, that's awesome. If you could start a company today, what would you solve? I guess if it was, what would you do, and what would it do?
This is going to sound just full of bullshit, but I'm actually doing what I love doing right now. I can't imagine doing anything else what I'm doing. I think I'm a technologist. I believe, in this rosy future of technology helping humans live a better life. So, I believe that AI is a game changer across the board. Right. And I want to help founders improve their probability of success. And I've done fairly well in my career. I don't need to make any more money. So if it was on my tombstone, it said, this dude helped tens of thousands of founders pursue a more happy life and a more successful life, that would make me happy. That would be a nice epitaph.
Yeah, and it's really tech that drives the world forward. So, all of these companies exist to solve human problems at the end of the day, and charge you for that sure. Right to solve that problem, right?
Yeah.
But that's the beautiful hand of capitalism, right?
No, it is. Well, yeah. I would, in my esoteric sort of way, I'd say we're just exchanging energy all the time. And if the more value you create for somebody, the more energy they get, the more they're willing to give you. So it's a nice exchange of energy.
Yeah, that's why I love the podcast. Same thing. So one word that describes your investment philosophy.
Trust the data. 3 words.
Yeah. Or you could just say data driven. Yeah. That's a hyphenated word.
Yeah, that's good enough. Data driven.
What's your favorite leisure activity to unwind?
I run.
Oh, you're a runner. So I cannot relate to this at all. I have to fool my body into running by playing basketball and other things, but I just can't. Like I have tried multiple times to become a runner, and I just can't do it.
Yeah. You know what?
I'm more of a sprinter.
You know what? It's one of those things where it's kind of like meditation, where when you first start meditating, your brain's just too active, you can't do it, and then you finally get to a place where you could just get into that zone. Running's the same way. You can get into that zone. It just takes a little bit of time, and then it's like meditating. It's just broken, right?
Yeah, it's like a walking meditation or running. Yeah, you're just sort of in the zone doing the thing. What's one trend that you think will define the next decade of venture capital?
I call it the power of one. And it's not just venture capital, but it's everything. I mean, it used to be if you wanted to have any significant change, you needed a massive company, a massive team. And we talked about it a little bit ago.
Yeah.
You got founders who are generating $1 million in revenue, and they're maybe by themselves, right?
Yeah.
The power, everything is going around in a good and bad ways, by the way, but it takes a fewer and fewer people to really cause havoc in this world as well. But
the immune system's so much stronger as well, right? So like on the net, everything's up and to the right. I think I agree with that. It's, do I aspire to have a big VC firm with a bunch of team members? I really don't. I'd rather have, kind of that virtual team ignite. All the people that back all the startups and back our funds to help. But do I want an empire build and have like a 1,000-person VC firm? I don't. I really don't. I'd rather keep it small and nimble. And I think a lot of founders are going to do that. Isn't that the whole thing? Like with Sam Altman and his group, there's some headlines of them betting won the first $1 billion. What was it? The first unicorn with one founder, solo founder,
right,
and no employees.
Yeah, we're
definitely in our lifetimes.
Yeah,
definitely
probably in our lifetime. Yeah, it's. It definitely takes a village. I'm a believer in that. if you want to create anything, surround yourself by amazing people like you have, right? With Ignite. And I don't think anything I've ever done and ever will do is really just me and a machine. It's my
Mm,
wife who's supporting me. It's my
right.
friends, my and I, quite frankly, I like, this is my first virtual company. I purposely hiring some people who live local because I just like hanging with people.
Right.
I'm a social animal, so I do miss the camaraderie of, my prior companies, having a group of people that we're all kind of go out and have a good time together and work
Yeah.
hard together too. So,
Right.
but yeah, you're right. The Power of One is happening. Everything we're doing is
Or
all
maybe the
technology.
power of few or something like that.
Yeah,
It's small groups of people, and maybe in the future there is still a head of marketing and a head of sales and a head of product and whatever,
yeah,
but they're all supported by AIs.
yeah.
It's all turtles all the way down.
It's definitely going to be a choice. I like your Power of Few, I think, better than my Power of One. But yeah, in that
Or
vein.
power small or something. Yeah, because AI is this democratizing high leverage technology. Well, this has been a great conversation. I could have talked to you for another, I know we went way over. So thanks for coming on.
Yeah, absolutely, Brian. Always a pleasure, buddy.